Now, I don't pay attention to fundamentals as much as I do the charts. I just want a stock that's going to move. Generally, what they do is with the Investors Business Daily is rate the stocks 1 through 100 on the IBD 100 and 1 through 20 on the IBD Big Cap 20. And when you pick up a copy of the Investors Business Daily, you'll see exactly what I mean. On Tuesday, they come out with the IBD 20, Big Cap 20s, and for the issue that I have in front of me, Research in Motion (RIM) is the top stock right now in the IBD 20. Now, RIM has a tremendous number of options. They're highly liquid. They do have a little bit wider bid-ask spreads, but that has something more to do with the volatility of the stock than anything. The volatility is pretty big on, on RIM. You can see the July options have an average implied volatility of 58.24%. If we take a look at their chart, the RIM chart, you can see that this stock has quite a bit of volatility. It does move around quite a bit, which is something that we're looking for in a stock. However, it's also pretty expensive. It's $132. So if I was looking for a stock to invest in at the beginning, I would take a look through the list, and let's say I wanted to have a little bit of a lower risk, but a lower opportunity, but also lower risk. So I might look at something that the number 8 stock on the IBD list that I'm looking at is NXY. Nexon, and that is, generally the stock has a nice uptrend to it. It's paused a little bit up here, but if it's still on the IBD 20, it could have some upside potential to it, and that might be a good candidate. If we take a look, we want to make sure that they have some options on it, and the average daily volume on this is approximately 1.9 million shares, so that's pretty good. But the problem is here is the bid-ask spread on the 40s. Let's say we wanted to purchase the stock with a covered position. Well, we buy the stock and we buy the 40 puts. We're talking about close to a 30-cent spread on these puts. And with a 48% volatility, it's a little bit more expensive. But let's say we wanted to buy 100 shares. Let's go ahead and analyze that. You've got a maximum risk of $226 on that. So it's not too bad, of course, with the unlimited upside potential, which is nice. However, you can do it a different way. Let's say you find a stock. Let me get back to my trade tab here for a second. Let's say you find a stock in the IBD 100, and in some cases they don't have options, or the bid-ask spread on the options is too large for your comfort. In other words, you're paying a 30-cent spread here. You're going to hold. It's not too much of a problem if you're going to hold the trade for quite a while. If you know you're going to hold it until at least July expiration, which is fine. But in some cases, you might find a stock that is, traded that either doesn't have options on it, or it has too large of a bid-ask spread. Well, what do? Are you locked out of those kind of trades? Well, not necessarily. So we're taking a look at Investors Business Daily, and I've gone through the IBD 100, I've gone through the IBD 20, and I haven't really found anything. Investors Business Daily also has a couple of sections in the newspaper which also can give you some ideas for stocks that you might like to purchase. And that is the NYS in the news, stocks in the news, and the NASDAQ stocks in the news. And I kind of look at both of those as well, because they kind of highlight stocks that are up and coming. There's plenty of ideas in the Investors Business Daily. You don't have to necessarily use the IBD 100 or the IBD 20. The NASDAQ stocks in the news has a couple of really interesting charts for some stocks there that may do very well. So I pull up one of the stocks that I'm interested in, and it's Almost Family Inc., which is AFAM. But as you can tell, there are no options for this stock. So are we stuck? That's the question. Let's say you wanted to buy some shares of AFAM. You really think this stock has absolutely wonderful potential over the long term. It's coming up against a resistance point here, which tried to bump up against a couple of times. You feel it's going to break out to the upside, and you really like to buy some of these shares. Now I wouldn't recommend it because the average daily volume on this stock is pretty low. It's less than looks like about less than 20,000 shares of well, yeah, about 20,000 shares or less, maybe 60,000 shares a day. So that may eliminate this kind of a stock. What you're really looking for is maybe a stock like another one that is looks like it has a little bit better daily volume, called Psychiatric Solutions, PSYS. Now, it doesn't meet my criteria of 1 million shares a day, but it has had a couple of days at which it got over 1 million shares. If we take a very close, a little bit closer look at this, it's only trading 147,000 shares today. Yeah, it's been up around anywhere between 700,000 and 500,000 shares. A couple of days where it hit 1 million, so it's starting to grow in popularity, and you really want to get in kind of early on this. The problem, of course, is that the options are probably extremely thinly traded. Let's take a quick look at that. Yeah, they're pretty thin. I mean, there's only 3 strike prices and they're $5 apart. You got 20 cent bid-ask spreads. If I took a look at the volume in open interest, they got 39 on the July options. There's only 39. That's the total open interest for these options. The puts only have 15 open. Open interest is only 15 contracts. That's pretty thin, So even though you like the stock, yeah, well, the number of shares being traded every single day isn't huge, but you feel that it has some potential. I've drawn a little flag pattern here, so it looks like it's a continuation pattern that may actually move the stock up a little bit higher. And you really want to get into this stock. What do you do? How do you protect yourself? Well, what you can do is you can go ahead and click on the buy. Let's say you only wanted to buy 100 shares just to open, just to get your feet wet in this stock and begin to have some sort of potential for the stock itself to determine whether or not it's going to move. How do you protect yourself in this stock? Okay, so let's say we've got we've got 100 shares. Let's just say, for example, that we want to buy 100 shares. Now, the options are not particularly attractive because they're really not very active here. The open interest, like I said, is only 15 on these 35 put contracts, and there's only 2 contracts outstanding open interest on these July 40s. And also they're pretty expensive, and the bid-ask spread is pretty wide. So what would we do here? Well, let's take this over to our Analyze tab, and oops, I lost that. Let me go back in here. Let's go over to our Analyze tab here. Now, here we are with 100 shares of our stock at $36.81. How do we protect our downside if the options are not particularly attractive on the stock, but we do want to own the stock? Well, what we're going to do is we're going to take a look at our delta, and our delta is actually 100, because on a stock, a delta will move stock will move point for point up or down with price changes in the stock. So our delta is always 100 on stocks. Now, what we can do is go up here, and what we're going to do is we're going to switch from a single symbol to a portfolio beta weighted. Remember this from our previous lessons of trying to determine the true delta of our portfolio based on the beta weighted positions of our portfolio. Well, we're going to do the same thing for this type of a trade. What we'd like to do is say, hey, I've got 100 shares of this stock, and I'd like to be able to protect it from any downside risk. In order to do that, I need to get delta neutral, or as close to delta neutral as I possibly can. In order to do that, then what I'd like to do is pick an index in which we could use in order to hedge this stock position. When we pick an index, we obviously want the most liquid index that we possibly can find. Preferably, we would like to have an index that has penny-wide spreads and also maybe $1 strikes between them. So that's why I like the Qs.